Hello, everyone. Welcome to this short explainer of the second edition of the Omega Files. Quick round of intros in the beginning. For those who have been watching this channel or following Indian venture or venture in general, he needs no introduction. We have Karthik Reddy, co-founder and managing partner of Blume Ventures. I am Adithya Santhosh. I've been with Blume for a little over 2 years now, and I primarily work with Karthik on all things strategy and portfolio. Now, some of you have come across this term, the Omega Files. We hope a good lot of you might have read the report that we put out last year. And some of you may be wondering, what are we talking about, right? What exactly is this amazing report that we have not heard about yet? So, for those of you and for everyone else, let's start with a quick refresher on what happened in 2023.
Sure. So when Adithya says he's going to do a short introduction, I think it's in the context of how much work he's put into the files. So this is not going to be as short as you imagine. There's a lot of ground to cover, and just the amount of effort that Adithya with his interns, Maitri and Naman, have put in has just been fantastic. So thanks for that. There's been a lot of independence in the way these learnings have been transmitted into the organization and how they magically turn into what we can share with all of you. So this was like, I think, a dream that was probably put in motion, even 5 years before the Omega Files came out. So I think the obsession was around two things. One is, why aren't we more transparent as an industry and share things upon completion at least? Mid-course, everything changes. You might have a star company today, and sadly, it might be dead in 2 years. That's the nature of venture capital. You might think it's a short IPO, and it might get acquired next month. So there's too many things that you can't deconstruct mid-course in the life of a fund. The name, as you recall from last year, came out after various options were thrown out there. I liked it, one, because it had a semblance of mystery attached to it. And I think private funds like venture capital funds are shrouded in mystery. And we wanted to sort of declassify that mystery. So it gave I think, came out with a nice ring to it. And Omega is the last letter of the Greek alphabet. So it's almost, the idea was to make it feel like it's the last word on a particular cycle. And we ironically not 100% completed our Fund 1 cycle, but it felt close to 90% last year, same time. So it felt like the right time. Something like everything was falling in place. We had somehow managed to, get out of a lot of our portfolio positions. And for the ones that we felt like we wanted to hold on, we executed an interesting structure of a continuity fund. And as far as Fund 1 investors were concerned, they had a sense of closure and a completion. And so Omega was signaling that completion of a fund cycle. Now, can I have a fund cycle every year? I can't. And which is what we are here to discuss today. What have we done with Omega 2 that we have not already dealt with in detail in Omega 1? And Omega 1 was fascinating because nobody had ever seen something like this before. And I've tested this with a lot of international investors, and it's the first of its kind in the world. So we should take some pride in that as a firm, not just my efforts, but the firm's efforts in delivering us an outcome and thought leadership that we want to be able to do this in India. Now, let's see how much we inspire most of our peers. As you know, we are happy to see more of our peers beginning to get comfortable around sharing this. So we'll come to that as well later in this episode. But on a whim, I asked, India Quotient last year, and they were like, yeah, we'll do it, because they'd already disclosed some part of it in the public domain. So I said, okay, we won't look like we're doing it in an isolated fashion, though we only gave them 2 pages and we deconstructed a lot. It was the beginning of something. And I think that's what I want Omega 2, 3, 4 to become and beyond. But the Fund 1 was like, to detail and double click on every slice of data that somebody sitting on the outside might have around how a venture fund operates. and how did it perform, and how did you find these founders? So we get these questions from friends, family, investors, founders. Hey, I know how we got introduced, but how did you meet these other 50 companies? And so I think we made it a fun exercise around founder stories, which was packaged to the second half of the report. But the first half, we went really deep in terms of trying to determine, are there various variables on which a fund's performance depends? Geography, education, which partner does it, which sector, right? How do follow-on checks perform versus, the first checks? Is it worth playing a follow-on check? So these are questions which everybody deliberates, and we go with popular learned knowledge, which is passed down generation to generation from VC fund managers. And I think we are doing our bit. And I think at the core, that's what it is. I think as one of the pioneers of this micro VC, now we've become a more larger institutional VC. But in the place of the first 10 micro VCs, now there are 150 plus. So what is their learning base going to come from? From our learnings. How do you do it? Can you meet each one of them in person and virally transmit? Tough. So why don't you give them more structured data rather than ambiguous knowledge? I remember this fun anecdote where somebody who had joined the firm in our team, I think we released it last year in December. This year it's going in November. But in November, he asked me, Karthik, when are you going to educate us on what actually happened in Funds 1 and 2 and what the learnings from that were? And I said, why don't you wait a few weeks and we'll tell the whole world. And you tell me what more you want to learn, because there's so much we want to put out there that I think you will get a lot of input, because he's new to venture capital and he wants to understand, what have I missed in the first 13 years of Blume? And that's kind of what we delivered with Omega. Yeah. We essentially became we almost at a very sort of idealistic level, we think it's a responsibility when we take public and private money to be able to say that we are accountable for it. We have no qualms in disclosing what happened to that capital. And then giving all these slices of data was just mind-blowing for someone who doesn't see this at a fund level. So much more to unravel as we write future Omegas. But Omega 1, the thrill was that, because nobody had ever done it before.
Anything which stands out to you from the reception this has received in the last 12 months, the first edition?
No, I think you're right. There were 2-3 things. One was, as you recall, I kind of nudged Shireen at CNBC, because she had featured us in a program 10 years before the release of Omega 1. It was exactly 10 years before. And it's interesting that question, the last question, the postscript of that
first episode.
No, the postscript of that episode shows Sanjay and me in a video, and it talks about, we give some punchlines and she covers, there's a voice overlay. And the way she ends is, broadly to say, these guys are crazy. They're doing 60 plus investments. Let's see how it performs. So it felt like that was the opening line for why an Omega had to be shared, right? What am I going to go and have a private chat with Shireen and tell her, hey, we did well, right? Or, we performed this way. And I think that opening was fantastic, because it allowed us to share back with the very folks who supported us 10 years ago, but also curious to know how this is going to play out. So replaying the story, rewinding the story was fascinating. Even for Fund 1 founders, just and they don't know their relative standing in the table. They say, I've done well. I gave you 20% of your fund back. It doesn't know whether that's pole position or number 4 or number 5. So a lot of folks don't know what the context of how they delivered as entrepreneurs in a fund was. So I think with each one of and LPs, of course, were if they're existing LPs or if they've evaluated me for funds 2, 3, and 4, they're seeing all this data. I have to present it to them. So it's only the LPs who've never actually been inside of Blume who are like wondering, what did these guys just do? Like, how come nobody ever else does this?
Yeah.
So that was the initial reaction. The reason or the fodder for what could go into an omega 2 or a 3 or a 4 is, in my view, is always going to be what questions people ask further of us.
Yeah.
And do we have data sets that can answer those questions? So that's kind of, I think the fun part of what we are trying to do. Because I have no new fund to report until Fund 2 matures. And then you declassify Fund 2, right? Fund 2 is going through its ups and downs right now. It's very far from that point.
Yeah.
So what do I do in between? So I think you asked me this question, I asked myself this question. But I think the most natural way to answer it and say, is there value in putting out an omega 2? Was there are a lot of unanswered questions.
Yeah.
And the Aam Janta is asking, what about this answer?
Yeah.
What about this question? So one, for example, was like, hey, you haven't shown us the IRR math. You've just shown us,
very popular one.
Yeah, which you've just shown multiples. What does it mean in terms of returns? 10 years doesn't look great, right? What they don't realize is it's not 10 years, it's cash flows. So funds work on cash inflows and outflows, and IRR has to be computed. So we said, can we be super transparent and show the computation of the IRR? Then they'll say, but yeah, this doesn't do as well against this asset, some fund. I can't dispute it because I haven't done the work. So we said, let's do the work. So I think you and the team did a fantastic job of, taking even the best in class funds that could have beaten us. And in one case, you have shown that as well, where let's compare with everything out there and show how if somebody had invested as opposed to putting money in Blume's funds in 1 and 1A, if they're just SIP'd into something else, how would it have performed? And I think that was the right approach. Thanks to Deepak Shenoy, if you're listening, of Capital Mind. We tested this approach and the math, and they blessed it as well. They said, this is how we compute and compare our investors who come into our funds as well. So I think that was the right way to do it. And that was, I think, the mathematically the most intriguing, challenging part of this year's Omega.
Yeah.
The other part, which is always going to be subjective, was, what has now become our favorite punchline in Blume is, our job as venture capitalists is to be pattern matchers. But every story worth telling is an exception to the pattern, right? And so, how do you prove that? And so, I think that's what intrigued us.
Yeah.
So, you can just say, hey, company A delivered a 200 crore outcome, company B delivered an 800 crore outcome. How are they supposed to make sense of that?
Yeah.
That math we showed last year. So, I think the exercise we did, the most taxing part of the exercise was to jog your memory for 14 years and go through. We did for all 70 plus companies.
Yeah, I'll get you some stats on that.
Yeah. So all 70 plus companies, we started seeing what could have been the points of failure or success, which helped this company. And then, as if you recall, we just kept adding columns because there are more. There are more variables, right? Everything from founder archetypes to first time, single founders, multiple founders, to running out of cash, to not having a capital structure that supports them. We tried everything. I mean, maybe AI will do a better job than you and I did someday. But I think you've done a commendable job of trying to take that data and build a correlation and a regression analysis of what variables talk to one another and does it affect performance. And I'm sure there are another 15 interesting cuts, but I think we presented 15 or 20 of those cuts. And I think that was something, again, these are not sacrosanct as you and I know.
Yeah.
Right? Every time you demonstrate a pattern, it breaks your own paradigm. Yeah. There are exceptions to this. That's why, you can show this. But I think it's interesting. Despite that, I think we've tried to show that it's a probabilistic game. Building companies and building great companies is a probability game. Yeah. So fundamentally, an entrepreneur can only weaponize themselves with what maximizes my probability. So if you feel like, hey, this is a solo journey, I would love to have another founder, it improves your probability in certain circumstances. If you've never done it before, it improves your probability. Everybody knows this, but people still disregard it. Yeah. So I said, let's show the data. Let's show what the 18 winners did. And let's show when they didn't do it, our hypothesis was, like, for example, a second founder matters. Yeah. What happened when you didn't have one? Yeah. Did you tend to lose more than win? Turns out it's true. right? And so I think that was a fascinating exercise. The third, I think, has become, I'm hoping more of my peers see the continued idealism of what we're doing. We had India Quotient last year, but I know we were on the verge of potentially getting as many as 5 funds this year.
Yes.
We'll settle for 3. There's always room in the next edition, So I think I like the fact that Omega can become a chronicler of Indian early venture history, right? And if that means in the future, 50% will be data that we pull from multiple sources, and we are teaching the venture craft, we are educating people on venture math to a wider set of data sets beyond Blume.
Yeah.
Why not? Or if others say, hey, we can't ever show that level of detail inside of Omega. I would like to show it myself. Please do it.
Happy to have you.
Please, and do it yourself. Right? If one of our guest funds today, K, on completion, decides that they want to do their own version of Omega, it'd be fantastic to see. Because we'll learn something new. We'll learn from the 2 companies that we missed in their fund and what they could have taught us. And I think that is something we're trying to achieve. I mean, theoretically, we all joke about whether AI will take our jobs in venture capital. I think the data patterns are more abstract in early stage venture. This is not growth. And if it's seed, and there could be better data patterns. So we could all agree that I think we should mine founders' minds more. Maybe in 2029, we'll be putting Neuralink receptors on every founder and then doing a 1-hour chat with them. Okay. And then having a set of 50 questions. And then maybe it gets more, more objective / intellectual in how you pick these folks. Yeah. But on what hypothesis will you test? We're trying to derive them today. And thanks again to K Capital, Honest, and Micromax's venture fund. There are 3 guest funds this year, and maybe we'll have 5 next year.
We have taken approximately, and this answers a point that you had raised previously, we have taken approximately 80 companies, 70 to 80 companies, evaluated them across 7 themes and 23 parameters, which resulted in an 1800 data point set.
Yeah.
It's fantastic. And in this quest for finding patterns, we answer age-old questions, which we keep hearing on and off throughout our journey. Does your market size matter? Do you stick to plan A, or do you pay heed to the markets and shift your strategy? What advantages do we get to maintaining a frugal mindset versus just, raising and burning? How did single founder companies fare against those which had multiple founders? Now, these questions have been asked, like I said, multiple times, and they have many answers. And quite a few of them have conventional nuggets of wisdom also. But rarely, if not ever, have they been answered from a data-backed lens. So that's what makes this edition of the Omega Files a very unique one.
Yeah.
So Karthik, how much does TAM matter?
Yeah. No, we keep having this debate. I think it's debate is only around whether the TAM is defined or not anymore.
Yeah.
I don't think there is any debate about whether it's been worth playing a small TAM or a niche market. Our data seems to suggest, if you look at one slide of the data, it will seem to suggest that some of the niche TAM ones have actually done fairly well.
Yeah.
The reality, as we double click on that, is actually they all pivoted. So they expanded TAM. So I think most great founders recognize that there's no point attempting, a sort of a sustainable, legendary company build out if they don't keep expanding TAM. So the answer is somewhere in between. It's not about small TAM, large TAM. It doesn't matter where you start. What you start is with addressing one deep behavior, right? So if Instagram started by, applying filters to photographs, that's what they did. That's all they did. Right? You could apply 8 or 10 or 12 different filters to photographs. And it didn't matter where you posted them as much as you could apply that filter. But by doing that, you built like a imagery-led social network. And then the applications just erupted. Now, if somebody just did that, there have been plenty of photograph apps which then tried to be apps which applied filters to photographs. Is that the market? That's not the market, right? The market was sharing of those photographs and then being driven by the classic social network phenomena of 1990, where 1% are the celebrities who share and the other 99 are happy to follow, right? And 9 will react, the other 90 are passive. But that's, you have to have known that it made more sense. So it was genius of two people, Kevin Systrom who built Instagram and Mark Zuckerberg who bought Instagram, that this is the true addressable market, not what you started with. So I think the answer is more nuanced. It's not about whether you define it at the beginning. Are you the kind of founder who can define it as you go along is the key question. So today you'll see even some of the largest companies today, and if you think about what's happening with Swiggy and Zomato today, they're essentially redefining their markets as they go along, right? One of them is talking about pharmacy delivery, the other one bought Blinkit, right? And fundamentally, you have to optimize to your strengths and build into those strengths to reshape the market opportunity. Otherwise, you'll be simply fighting for food delivery and restaurant reviews. That's how it happened. Now, whether competition is forcing it, whether customers are forcing it, that's not as relevant. Whether capital is forcing it, for that matter. If you have too much capital, you get ideas. Right? And so it could be any of those: competition, customers, capital. So we have 3 C's at least to make it catchy. And that then allows you to reimagine the addressable market. So our colleague Sajid says that. He says, like, I'm even more interested in companies that can, define the TAM afresh rather than be judged on the TAM that they pitch.
If you look at our Fund 1 portfolio, we've seen companies go into niche markets. We've seen companies go into large markets. And these, again, as you said, were markets that they pitched and the markets that they entered. Our data here shows that while performance-wise, niche and large markets, they're not really off. They're good. Both of them are good. But large markets reward better.
Yeah.
In fact, even when we see companies that have started off in a smaller TAM, they eventually, like as our data said, over half of them changed. They changed course and they went back to markets which were bigger and more pluckier. So,
quote unquote, change markets.
Yeah.
As opposed to change the original variables they were playing with. So I'll tell you what I mean. So if you have a company that was playing only to serve SMBs, they redefined to play enterprise because the addressable market definition that they picked originally was incorrect. There was far more money and capacity to pay, and it was far more of a painkiller as opposed to a vitamin for an SMB.
Yeah.
So there's this analogy of painkiller versus vitamin. Why would you chase a market which looks at it as a vitamin? Automatically reduces your ability to earn from that market. Similarly, the reason a lot of our companies today are trying to go global is because they're redefining market. So it's not like there isn't a large $10 billion company of that nature in the US. Question is, can you build a similar $10 billion company in India?
Yeah.
Tough, right? Which is why Ultra Human is challenging Aura on its turf.
Yeah.
Which is why Grey Orange is in the US. So you redefine markets on any of those parameters, that's good enough, I feel.
Yeah.
We're not saying you pivot out entirely and start chasing something else. In fact, we have learnings from that later on.
That's right.
That, that's not necessarily a good idea either. So I feel like when you deconstructed it in the next slide, you found that people who listened to the market and adapted changed the definition of the market size and therefore did much better. Yeah. The people who didn't really fared very badly.
Yeah.
And that's, I think, the reality.
Now, on a blended basis, Karthik, it showed that while, yes, your market, the market that you choose to enter into is important, being on time paid off more than being early. In fact, the best performers, if you see the slide, are the ones which have been large market solutions and on-time solutions. For example, Turtlement, Purple, etc.
Life, it's all about timing.
Yeah.
And you can lose that advantage too over a period of time if you don't keep evolving as well. So I think these head starts are relatively small in the long-term nature of the business.
Yeah.
So there might be, like in our own business, there might be a lot of fund managers who catch up with us soon if you don't keep evolving. So it's no different for a company, right? But I think you're right that the data seems to suggest that if you did get those variables right at entry, you tended to outperform. And I'm not surprised by that because the inflection point gets delayed. What will be interesting now since we keep talking about what will we put in future editions of Omega, is to rework some of this data when the actual end journeys are completed. Because the pivot point might happen much later, as we just saw now with E2E networks.
Yeah.
We've sold the position, right? But in the public market, catching the Gen AI wave, the compute needs are off the charts. There's a localization move. It's caught in a market wave, a government wave, and was well poised for it. Did the first 10 years shareholders gain from it? Other than the founders, no. Founders are happy. They're still going to make, create a lot of value for themselves and new shareholders. But the old shareholders didn't make enough, right? So I think timing keeps shifting. And it's inevitable that if you actually lock up the time frame in which you want to evaluate, which is what we did. We've locked it up. It's 10 years. In 20 years, some of this might change. Right? And so that's the thing about enterprise building and versus startups. You're measuring startups. In an enterprise build out, the guy from behind can come and win. Right? Or, as you rightly pointed out, if you're too early, and I would argue, I love Kabir, but like if you look at the failure of Dunzo, if you look at where we ended up in 6 years, we probably tweaked and pivoted the business model out 5-6 times to evolve with the market. We did all the right things. But some younger kid who's more enterprising in Zepto comes and essentially takes the best, most evolved opportunity set and doesn't distract himself with anything else and launches only that model. Right? So you look at that vantage point and you look at the amount of capital and effort that went in to get to where Dunzo was in 21 and look at where Zepto got to in 21. Actually, Zepto had the head start. Ironically. Right? So, in many ways, yes, they might have had capital and employee base, but had a head start in terms of having no baggage. So, timing does matter clearly. And you can see guys who are playing into somebody else's territory. If you're not weaponized like you were in Zepto, you can't win. Why isn't there 5 other challengers in quick commerce? Because it costs a lot of money. Somebody took a chance on one great team, but it's not like 10 people took a chance. So if you are entering into somebody else's TAM, I think if you want to win, you got to be weaponized more. So if you look at some of the companies that went in there and didn't do as well, what is the general VC market reaction? Hey, the market is crowded, so I don't think it's a great idea to play there. We won't fund it. Gone. You have no weapons. How can you actually go win that market? So you might be surprised. There might be a great company, like a Zepto equivalent in some other category, which comes late and wins. Right? Even though it's entering into somebody else's TAM, into a proven market. So I think the best combination has been when you defined the TAM afresh, you rode a bunch of tailwinds like new regulation, like Turtlement had regulation in its favor. So suddenly it burst out. But it's not a long-standing advantage. Today, everybody's copied it. Policy Bazaar has the same model. Insurance Dekh has the same model. How do you compete then? So I feel like these are short-term advantages structurally. You have to leverage them, which is why in this slide you will see there is no conclusive slam dunk behavior. All cohorts have done well in all quadrants because there'll always be the best companies will always do well. And a lot of the other companies may or may not have done that well. So which is why also finding that skew, the laggards might be pulling down the best companies in each quadrant. So we haven't done a quadruple click on this, but If you do it, there'll be more data you can cull out. But basically, it shows that you can win in any quadrant, but with the right resources.
Yeah. We did speak about markets. What's the best, how to choose your size, right? Can you win in a large market and win in a niche market? We spoke about how it's not exactly a static measure, it's more of a fluid measure. And a point that you had highlighted here about what it takes to win in a large market with dense competition. Funding matters a lot.
I think a lot of our companies could have executed better, faster if they had the right capital partners. We were severely under-equipped to go and give them millions of dollars. By the way, this is the era where, just for the viewers' benefits, the funds in total were 100 odd crores, right? So 100 crores in today's context is nothing. It's one large Series A.
Yeah.
It was the entire fund we had. And so it's not like you could have built reserves or capabilities to go and pull off, the funding required to be able to accelerate growth. So we were entirely at the mercy of the market. Actually, if you think about the evolution of Blume, it's primarily to de-risk our own selves and our own companies from that kind of dependency. Can't be so dependent. So the reality is you are dependent.
Yeah.
So, and in a thin market like ours, where the funnel thins very rapidly, we go from hundreds plus, 150 plus pre-seed players today to much fewer pre-Series A players like us, to even fewer Series A players and even fewer Series B players. The funnel sharpens very, very quickly. So what that means is that your chances of getting funded every new round are lower and lower. So suppose your competition gets funded. You should be paranoid. Because if you don't get funded and you're trying to play the same game, you're finished. So I think the reason most of our companies in that cohort did well is because they were smart enough or committed enough to building, whether they got capital or not. That's not an easy trait in 2024, right? It was okay then because the opportunity cost in a smaller startup market was lower. Today, the opportunity cost is higher. Right? So how many cases have you heard in the last 2 years where people have shut down companies? They've returned some capital. Some have died entirely because there's no capital. Yesterday, there was, some startup store school which said we're shutting down. It happens all the time now. Back then, I think the founders thought about what else would I do? Right? And it was not a vibrant startup ecosystem where a failed founder would go get funded. Today, failed founders, not glorified, but they do get funded if they tried hard. Back then, you wouldn't ever have got funded. So I think circumstances led to a 2011 to 15 vintage founder saying, frugal or otherwise, if I'm passionate and I believe in it, I'll make it. So you have a miraculous number of founders in Fund 1 who survived in a very frugal mindset. I don't think it's necessarily a good thing. I think it's great they pulled it off. So the data says they made it big because they hardly spent any money. So the multiplier is the best, right? So we've determined the winning outcome by the multiplier size, not by whether they got to $1 billion or not. If you look at that metric, this won't work because you never got the capital to be able to grow to $1 billion. You're all stuck at 100, 200, $300 million outcomes. And eventually the inflection point might come. I'm not saying no. E2E again as an example. Or Exotel today just took off. And now hopefully will list and hopefully will become a public company. But time's not on your side. And so I think it's a great virtue that founders should have around frugality. They should also not get carried away by spending unjudiciously. Beyond the capacity of the market to absorb those dollars. So if you're a consumer play or an enterprise play, unless the enterprise is saying on the first meeting, I'm buying your product, why would you spend more? If it's taking 8 meetings, it's not like by throwing more money, you're going to shorten that to 6. Only then you should be spending more. So which is why B2B companies also succeeded in Fund 1, by the way, more than B2C companies. Because they're listening to the customer. Only if the customer pays, they know they have a business. They're not throwing money at the customer trying to acquire them. So B2B had a disproportionate win rate. It had the frugal mindset works in B2B more than B2C. You can't compete in B2C with no money at all, no marketing at all, etc. You can't build a brand nationwide just with a small product. And the final point I want to make is that if you're capable of going toe to toe, it's very tempting, good or bad, to keep pace with the most badly acting, character in the mix. Which means if company A has raised 200 million and you've raised 120 million, and they're running through a whole bunch of capital, you can't not play that game unless you're playing a very different game.
Yeah.
So I feel in taxi for sure that's what happened. Right? You're playing with Ola and Uber. Either the cap table decides that you can compete with the same amount of dollars, or you play a different game, or you fold up. Fold up as in you get acquired in this case, which is why Taxi for Sure got acquired by Ola. So the room is deciding that we don't have deep pockets to play this game. And it's very different when you have, 20 employees and you can show frugality. When you're competing head on with Ola and you're running through millions of dollars a month, you can't say I'll win with frugality. So then you make the next best choice, which is find a home for the business. And you aggregate and you have a strategic discussion at the boardroom level. And that's what happened.
So everyone has this question, right? Okay, I want to start it. But do I go at it alone? Or does it make a difference if I get somebody else to share the burden, to act as a sounding board? Or am I capable enough to run this journey myself?
Yeah, it's an age-old question. It's been answered many times. But again, for us, our data is beginning to show that, if you look at multi-founder startups, they've done better.
Yeah.
I think it's also an era where there was not enough startup knowledge, maturity.
Yeah.
This number might shrink with every cycle. Who knows, right? I think Fund 2 also this will be true if we'll know in 4 years. But in Fund 3 and 4, it might shrink a little. It goes back to what you alluded to. By 3, in 2018, you had these second-time founders with significant experience and under their belt who came in. Even there, you have two complexions of it.
Yeah.
There's someone who's worked at one of those places, but has actually never gone and raised a rupee themselves. Right? They might have hired a whole bunch of people, so they might be good at hiring, but not at raising money, for example. And there is a serial entrepreneur who's actually done it all. So there's a spectrum, right? And I think the further up you go in the spectrum, the further it is okay to have a single founder startup. YC is the other extreme. YC basically believes that people who will come to them are not seasoned. They're young founders. So actually insists that if you don't have a team, you can't pitch. They don't entertain single founders, right? So because their belief is that there's no way you can build a world-class business all by yourself as a first-time founder. And data seems to be suggesting that. Yeah. So it's not a novel thought. I think we were testing a hypothesis which are popular paradigms.
Yeah.
So all of our things is validating it.
Yeah.
So I'm not saying, there's a radically new. Like if it was the other way around, then it would be radical. We're playing into the popular paradigms. And we're showing the data suggests the same. Right? And if you didn't do that, and if you're trying to be a cowboy and you're a first-time founder with trying to build all by yourself, we see some terrible performance.
Yep.
So I think the same thing. We're warning people. We're not saying you don't have a right to prove me wrong. We're warning people that your probabilities start dropping. That's all. Yeah. And the data seems to suggest that. But I think in 2024, if you look at our funds 3 and 4, we've started seeing repeat founders. They call themselves founding teams. It's more clever. I feel it's clever. I'll tell you why. It allocates the right amount of weight on each founding team member. Not like, we both came from the same college dorm, so we should be 50-50. Or we worked in, Flipkart together, so we should be 50-50. Because we don't know which other way to have the hard conversation on why one of us should be 70 and one should be 30. So I don't necessarily think that's a good idea. So in very young raw teams, sometimes I ask, what's your ownership mix? Very early in the conversation. Because if I get a sense that you're equally divided, but your future is not equally representative of that division of work, your rewards are not proportionate to it, then you've structured it wrong. It's going to create a problem in the future.
Yeah.
And dozens of founders left and created those problems as predicted. And that's exactly what we don't want in the design of the problem in 2024.
like we keep hearing every company or every founder talk a lot about their the vision for the business, the mission for their company, and we normally associate that to be static, right? It not really change. But here we saw that in a fair bit of cases, what they initially intended to set out to, and they initially pitched to us as their vision to build out, it didn't move.
So the biggest motivation to stay the course is not whether you got funded or whether your co-founder left or not. Is it because you want to stay true to the vision that you had when you came into the... So that's why the tag missionary founders or visionary founders. It's important because then you're not worried about 1, 2, 3 or glitches in the timeline. Every problem that can happen in a startup is a 1 to 3 year glitch in the timeline. In a 20, 30 year journey, it's not an expensive glitch. In a 7 or 8 year journey, it's a very expensive glitch. The only thing that tides you over those little, bottlenecks is
speed bumps. Yeah.
Speed bumps is your ability to hold on to your vision, I feel. Not your ability to necessarily hold on to a co-founder or capital, right? And that's why you'll see a lot of them have overcome that.
Yeah.
So it's not surprising at all at one level. I'm not saying it should be static. See, don't confuse vision and TAM. Right? Vision is that, hey, new digital infrastructure is coming. It will change the way certain businesses work in a certain way. So whether that's Idify, Exotel, or WebEngage, or Zopper, the vision was that. They're not obsessing about isi customer ko bechenge. This is the TAM. This is the only way I'll do it. This is the only price point I do it. Those are all stupid to hold on to. But does that primary vision stick? Yeah, I think so. Now, what happens is sometimes if you're not sold that well to your entire co-founding team, there's no 12th employee who believes in this vision. Leave alone the 250th employee. How do you build great companies? So please understand that it's a distilling of that vision through the organization is very important. So how can you have somebody straying at the top? Right? What you've hired for me, right? You're looking at it as, if you don't understand that I'm consistent on my vision, how will you hire? Right?
Yeah.
So I don't think it's the simplicity around did they just hold on to it or not. It's the classic abstraction, which nobody can perfectly define, but is very important, is how do you build a great organization if you didn't have one? In the first 8-10 years, the founders at the helm. And what they leave behind after that, theoretically anybody can run because it's a good business. But until that point, it's the founder's vision that takes the business through there.
Yeah.
And that's why you're seeing, if they didn't have that, or if that you believed it straight, or like, for example, the reason we have sample sets in that is either people just gave up on it, from my memory. There are at least half a dozen pivots I can recall where the original vision was either confused and didn't exist, or they just pivoted entirely out. It's like paisa mila hai, aadha bacha hai. Let's go chase another thing with the other 50% because this is called a pivot. And let's go chase that to see whether we survive and we raise money. How is that vision?
Grasping at all straws, essentially. That point.
Yeah. So they misunderstood survival. Survival is not for that reason. So now we tell people, chamka nahi, and if you want to give up, please kill the company. Return half the money. Then go build a new vision. Whether that's in 3 weeks or 3 years, it doesn't matter to me. Don't try and build it inside the same company. I know it's going to fail. And that's what we've seen. Almost always fails. Yeah. So you might get small outcomes. See, I think the reason in some of these graphs you see 1x and 1.5x as an aggregate. So the dollars are so little. 1 or 2 hit stories in that could have made up for all the small losses.
Yeah.
But now if you go and apply it to a $250 million fund, these will all be sub 1x.
Yeah.
That's my take.
Karthik, almost 1/3 of our companies in Fund 1 underwent a near-death experience. That's a large number if you consider almost 80 count portfolio. And predictably or sadly, 60% did not make it. I think they came all the way till the end and they just couldn't pull through. But the 40% that lived to tell the tale did astonishingly well for us. So it seems like adversities have brought out the best in them, and they just outperformed.
I mean, the real life analogy is you'll hear, you're too young to hear, but I've already started hearing these stories of my peer set. We've lost like a classmate, before he turned 50. Another one who just crossed 50 had a stroke while he went to office, mini stroke, and then was rushed to the hospital. So when you're looking at an individual patient with high medical care, a lot of situations can be reclaimed. Looking at a company with 100 variables is not easy. So it's much easier said than done, because you're not playing for yourself, you're playing for everyone. You can't meet payroll, you're dead. Right? Can you motivate anybody outside the founders and 3 other people by saying you'll somehow survive in near-death mode for another 6 months? Very tough. So it doesn't surprise me that, to your point, you said it's shocking they die. Of course they'll die, right? It's not the same as going and getting that help. When that event happens, though, you start thinking about, like, I need to fix myself. If I need another 20, 25 years, I'm like too young to go, and my kids are too young. I'm 50. I want to see everything through till 75. So the motivations are very different at a personal level. But I feel at a founder level, they're not very different, right? So a lot of the other variables you've been discussing for the last 45 minutes have to play in as well, right? You have to have a business model that gives you some revenue. You can't have zero revenue and say near-death soil somewhere, right? You have to have some internal investor sometimes who coughs up a bridge somehow, right? You have to have some co-founder who helps you tide through this and say, we both do it together. Like Sriram of Rootmatic, I hope he'll make next year's Omega as one of the holdouts who comes in. I'm sure without no support in his founding team, he might have given up by now. He says, I've come near death 4 times. He's not even there in our thing because we haven't given him the credit, because we don't know what the end outcome will be. Touch wood, he'll deliver a great outcome by next year for us and for himself, right? So now if you look at a guy like that, 10 other variables could have killed him, right? Any one of the ones I mentioned, we've discussed in the last 7, 8 variables we discussed today, could have easily killed him. So there's got to be 3 or 4 of them ticking, which is what we find in our success stories, right? How do the success stories overcome challenges or near deaths or whatever? Because something else motivated and nudged them to somehow cross that barrier. It's like the doctor equivalent came in, or the driver took him to the hospital on time. He detected it on time, or medicine saved him. So whatever it could be, near death is that, right? And miraculously something comes and saves you. And then you rebuild, and when you rebuild from a near death, you build better, unless you're suicidal, right? And no founder is deliberately suicidal from a company perspective. They want to build. They've spent 3 years, 4 years, 5 years building this and nothing else. So they'll work hard, but you have to give them the glimpses of hope.
We spoke in the first or the opening section of this video about how winners are exceptions to all the points that we had discussed so far.
Everybody knows this, but I think it was useful, and we tried not to pointedly show which companies went through what by doing it in 2 interesting ways. So when you show the overall map and you see the number of yellow boxes on the slide, you know that, oh my God, this is the winner set. And it's like 30-40% populated. Right? So what happens to the folks who died as a startup? And that will obviously be more. So a lot of things don't go right. And the best founders overcome them. So that's natural. I think what we've tried to do is take 8 examples, not get into semantics and disputes with both the founders and within the team, whether it's a perfect articulation of risk. And therefore, we masked the names, as you've helped us do. And essentially, with those masked names, we're showing 8 case studies around. These are 8 of our 18 winners. Look at the number of challenges that were lined up in their favor. Look at the number of positives that were going. And despite that, they hit it out of the park. And people ask, you just told us that without any narrative. So we've added a bit of narrative. So I think it would be good for folks to say, hey, I relate to, these are, I think, both the failures and successes and the learnings and the pattern matching, predominantly written for what founders can take away from, 75 plus companies doing this in a 4-year cycle in a much tougher environment. And micro VCs in this era will also see this because they're backing more and more of these young first-time founders. So for both those sets of stakeholders, I think there's a lot of learning packed into this saying, what do you watch out for? And when you see them, how do you nip them in the bud? Like if you see, you're playing into with a certain headwind against you, how can you overcome it? And so we just try to give examples and stories to inspire people that it's possible. Despite headwinds, you can come out shining. But then you got to address them, and you got to probably put these variables as you cut the check or before cutting the check. And say, where do you see the risks playing out the most? And you say, oh, single founder. I still love them enough that I'm going to write the check. But then what else should I watch out for? Can single founders with pivots actually do very well? They don't do very well. So on and so forth. But here, they're all successful. So we're trying to say, how do they pull this off? And we're trying to give some illustration of how they overcame those challenges. So I like this section. It's crisp. It's like a little bit of a storytelling.
So as a 123 crore fund, it's difficult for us to imagine what could be potential downstream impacts of that portfolio, right?
Yeah.
Surprisingly, it's a lot. So we do, in the report, we talk about how we have taken, again, the ones which did really well in the portfolio, the winners, and tried to condense in different axes, we tried to show how they have been able to make a positive change from an employment creation perspective, from an employee wealth creation perspective, how they have been able to impact lakhs of customers, both India and abroad, and how we have contributed fairly much towards nation building by an enormous amount of money that has gone in taxes. How did we facilitate research and development? But again, a massive amount of money. So the amounts that you see here are actually multiples of the fund size itself. So that just goes to show how downstream impact of a portfolio is super important.
This one is close to my heart, and I think I can go on for we could have expanded this section to 10 more slides. As you know, I know that founders won't be able to easily get this data. I had to chase them 3 times over. It's also legacy data because most of these companies have exited or it's part of their old legacy. And when I was at IBCA as the chair, one of my dreams was to see whether we can get like this kind of data on a consolidated basis in the country. So it's cool to say that as an industry, we throw tens of billions of dollars. Government intuitively gets it, which is why Startup India, and there's a lot of support for us. But are they truly being able to measure this? So there are various consulting outputs that create and project multiplicative factors. So for example, every $1 million creates n number of jobs. So while all of that was understood, and we created a nation building report, which we presented to the government, I said, look, I can control what I can control. So let's not go to all 75, 80 companies. Let's go to the 18, 20, 20, whoever, like the winners. And we asked a select set, as you can see. And let's ask them 7, 8 questions, right? And like you rightly said, it's about employability, nation building. How do customers care about us? So I think the fact that you start as an early stage VC, one of the thrills is that you originate a certain solution set. And to deliver that solution set, you build value by way of business creation. And the scale of that is incredibly multiplicative given how little dollars goes in that pre-Series A. And so one of the joys of being a pre-Series A fund is to see the multiplicative factor of that impact. Right? And so people might say, oh, this is like, what stake will you get for a small fund? Oh, how tiny a fund. They don't realize that everything starts with that. Right? If you didn't start with that, where is that whole process of discovery and nurturing, or first line of entrepreneurship, is very difficult otherwise for a very large fund.
Yeah.
And we faced that in Fund 1. And I saw coincidentally K's capital, we had 1 plus 1A is 123 crores. K's capital is exactly the same number. So there were a whole bunch of micro VCs from that era, which collectively might have put 750 crores to work for 5 years. And then you see the trickle-down multiplicative effect on unicorns created, wealth created. That's the usual tom-tomming.
Yeah.
Oh, I have $2 billion of market cap. For me, the funny thing is, we were speaking of it from a 1A perspective. The journeys are not done. So actually, I'm still creating more and more market cap, right? In E2E, in Purple, etc. The fund might have exited, but the market cap is getting created. So I want to keep a tab on this. Because I want to be able to say that eventually you can write off 80% of what I've done. That 20% in the power law will just keep compounding. It's beautiful to see. And so you say, oh, no, so you guys are capitalists, you think only about money. Or if you were an impact fund, I would be more motivated to give you money. I heard this when pitching Fund 1, by the way. That's why it's close to my heart. Somebody said, if you're an impact fund, I would give you the money. You're a generalist fund, so I won't give you. So I said, what do you mean? Almost everything we do is impact. But it's not seen that way. So that I had to overcome that kida from 14 years. Right? So for me, it was important to show that all of what we've done has created impact. I'm not trying to be perfect in the assessment of that. I'm just trying to give an idea. It's all about ideas. Oh, so much payroll went into companies in this era, from this Blume Fund 1 era, that 1,700, 1,800 crores worth of taxes got paid. That's a lot of gross output for this country, right? Probably funded like some highway, right? Not us, not our money, the journeys we started. So not to confuse with the fact that we didn't do all of that by ourselves. The founders are doing it, a lot more capital coming after us. But the net impact of what you started as the first institutional check in every one of these journeys creates a massive trickle-down effect. And that's I think, half the joy of doing venture capital. So it would be unfair just to talk about performance, numbers, and not talk about downstream impact that entrepreneurship creates. And this is like as objective as you can get. People say, one classmate of mine was a professor at Michigan Ann Arbor Business School. Had a coffee with me at the South Korea here recently. And somebody said it, and he said it in his cute way, but he said, venture capital is just beautiful. You guys are doing God's work. You give jobs, right? You create jobs. And and that's what I want people to take away, right, from this section. That it's not about accuracy, it's not about perfection, it's not about whether my money did it or Tiger's money or Axel or Sequoia's money did it. It's like collectively that's what we're doing. And this is what I keep trying to push in government forums. You're missing the wood for the trees. You're basically saying, this regulation, that imposition, not understanding we're changing the face of the country and consistently doing it, and we're collectively doing it.
We'll try to gloss over probably the hottest section that's being awaited this year. It's on the performance piece, and specifically on how did our IRRs measure with that of the listed market assets.
Yeah.
So
I think I'll caveat, as we always do, in the spirit of transparency, we should also be transparent that we presented gross returns. But after accounting for fees, which is a big chunk in our asset class, because we take anywhere between 1.5% and 2% per annum. We take it over a long period of time. So for every 100 rupees that goes in, a good 15-20% plus goes out as expenses. So what we're deploying is only 80. But these returns are not on 80. These returns are on 100. Because that's how we are measured. That said, we also get a share of profit. And there's tax differences between public assets, gold, fixed income, AIFs. There's short term, there's long term, there's all sorts of things. So we've not gone into the depth of all of that because it's impossible to distill the cash flows. What we've tried to do is simulate that if you gave money to Blume through a manual decision in Fund 1/1A. And if you gave money to a bot to mimic that decision into any asset class, how did we perform? That's kind of what we've done. We think that's a fairest comparison in methodology. We got that vetted, as I said, by our friends in Capital Mind. And we've demonstrated that, thankfully, at least in this cycle, we've shown that we're better than almost any asset class out there on a gross basis. So it's because the 4-5x that we've generated across 1 and 1A has not been on the back of putting all the money in the first year and taking it out in the 12th or 13th year. It's a complex set of cash flows. So I think what you guys have done well is to be able to show the cash flows. The J curve itself is a cash flow representation. We've also given an example of how individual LP's cash flows look like. So when you look at that, you know that this is not easily benchmarkable. You have to go and do this in-depth analysis. And in classic Blume tradition, we have put the workings out there as a clickable link. So people can go and look at it.
Feel free to look, audit. In fact, if you have more ideas on how we could do it better,
that's good.
That
is exactly what led to this section being so robust. So if there's feedback, we'll be happy to take it. When you invest in a public asset, the whole country has gotten to a mindset of mutual fund cycling. Before that, it was up FD mein rehte the, right? So every month or every quarter, you put money. But you have the ability to systematically save. But in AI, if you're trying to game the cash flows, that makes no sense to me. So when people, now close friends ask, should I put 1 crore? You seem to be doing well. And I said, not if you don't think of it as a 10-12 year SIP. Don't put money. Right? So I think the subtle underlying learning of this, which this kind of a podcast allows us to communicate, is don't play AIFs as a tactical thing. Play it exactly like how you would play a mutual fund, as an SIP. So into each fund cycle, anyway, your cash flows, as we are showing you through the graphs, are distributed through 5 years. So you're only giving 20% of the money every year. You're not giving all of the money up front. So it's already an SIP. Then don't make the mistake of not playing the next fund, because it might outperform by 8 percentage points or 10 percentage points, which is what this has done. So if you had played a buck here and a buck there, you would have actually gotten a much better IRR. Do you go to a mutual fund house and say, I will play less in one cycle, more in one cycle. I will not play in the first 3 years and will play in the next 3 years, or vice versa. You don't say that. An SIP is an SIP is an SIP. You just keep at it for 5, 6, 8, 10 years. That's when you get the best compounded returns. So my message, primarily using these graph sets, were two. One is, how do we benchmark? And B, if you're going to do AIFs, build in the behavior and bake it into your head that it's AIFs are actually SIPs too. They're SIPs, and that's how they should be seen. If you ever do an AIF, don't do staccato investing into like a random fund here, there. Don't do the next one. You're going to be unhappy, irrespective at the end of the 10th year.
Do you want to click a little bit on what can people expect from edition 2? I know when I asked a couple of folks that we're going to release episode 2, they said, oh, fund 2 ho gaya. So I said, no.
We have to set expectations, especially because I look at fund 2, it's at the 9th year. It's already a 12-year fund. So 3 saal aur bhi hai. And I don't know whether I'll have enough proximity to closure to be able to shutter the fund down and report it. As I said, I won't do it mid-course. So we have 3 more omegas really, where we might not report fund 2. So the good news is, as you know, and the market probably knows, 10 of our best fund 1 companies have rolled over. They're still thriving. 2 of them have gone public. So we're tracking another 10, 12 companies, 10 where I have vested interest in seeing them through. And so their progression is something that I genuinely want to bring new dimensions to every year. What happens after one slide, I don't know whether we should include it finally when we put out the final report in the next day or 2, is around whether we show the compounding after the 7th, 8th year. Which is very amazingly refreshing to see that things can compound further after the 7th, 8th year. So therefore, there's a lot of journeying in one itself. That's part one. And as you said, respond to double clicks, questions. It's a lot of data. It's data intensive. We don't have necessarily the databases from everything pre-2015 to be able to go beyond what we've shown so far. But I think what we could do is similarly postulate some hypothesis and go and seek out this data from other peer firms. So, for example, can we take a vertical slice of this? Right? For example, can we take unicorns pre-2015 and see how much capital went in there? How capital efficient were they? We keep getting asked, how come we didn't see that kind of DPI? So as an industry, can we use Omega cleverly? And as one of the early participants from the domestic side, can we keep pushing those boundaries and pushing new learnings? Is my motivation. And we might be able to share some data along the way, which is not relevant specifically to a fund, but a theme. So I think as the industry is verticalized and has become more specialized, the learnings are going to get even more fun, is my take. And that's what I'm anticipating will happen in 3, 4, 5. We'll see. It's too early, but as you recall, last year, the minute we published 1, we started filling an Excel sheet on what might go into 2. So maybe that's what will happen this time.
Please feel free to take a good 1-2 hours of your weekend, go through the report in detail. If there's anything that you like, please take it out, share it with the ecosystem. If there's things that you have questions about, like always, tweet about it. We are watching. And you never know, we might take a section of the next year's report to address your questions on that, like how the IRR queries were addressed this time. And
thanks for all the support. Thanks for translating that original vision 5-7 years ago into 2 editions of this now. And looking forward to what's in store for the rest of the decade.